The current live trading session has SoFi Technologies Inc. trading right at $27.86, representing a sharp intraday decline of approximately 5.9% as the market digests the latest headlines. We are seeing significant volatility this morning, December 5, 2025, with the stock pulling back from its recent highs near $33. The tape is active, and the red numbers on your screen are telling a very specific story about supply and demand dynamics occurring at this very second. While the broader indices are chopping around, SoFi is under specific pressure, decoupling from the general Fintech sector momentum we have seen earlier this week. The volume is already surging past typical morning averages, indicating that both institutions and retail traders are aggressively repositioning their portfolios in response to the company's latest strategic maneuver. Most investors looking at this drop are immediately feeling the sting of a red portfolio day, assuming that something has gone fundamentally wrong with the business. The expectation here is that a stock dropping nearly 6% is a signal to flee, a sign of weakness, or an indicator that the growth story is fracturing. The typical reaction is panic, followed by a quick click of the sell button to preserve gains from the massive run-up we have seen throughout 2025. However, the reality of this situation is far more nuanced and, frankly, much more interesting than a simple sell-off. The drop you are seeing is not due to a broken business model or missed earnings. It is a mechanical repricing driven by SoFi's announcement of a $1.5 billion public stock offering priced at $27.50 per share. This is a classic case of short-term supply shock creating a long-term opportunity. But it forces us to ask a difficult question. Why does a company that just posted record profits need this much fresh capital right now? That is the discrepancy between the fearful expectation of dilution and the potential reality of a massive strategic war chest being assembled before our eyes. To understand why this is happening, we have to look past the immediate red candle on the chart and look at the company's trajectory over the last 12 months. SoFi has effectively transformed itself from a battleground stock into a legitimate profitability engine. The market expectation for years was that fintechs were great at growing users but terrible at making actual net income. SoFi has shattered that perception. We're looking at a company that just delivered a third-quarter performance that silenced almost every bear on Wall Street. They reported adjusted net revenue of $950 million, which is a 38% increase year over year. But the real story, the one that matters for your long-term thesis, is the bottom line. They posted GAAP net income of $139 million. Remember when critics said they would never be profitable? They have now strung together 8 consecutive GAAP profitability. The expectation was endless cash burn. The reality is a cash-generating machine that is arguably the most disciplined player in the space. When you look at the landscape of online investing and individual brokerage accounts, the competition is fierce. You have giants like Fidelity and Schwab Intelligent Portfolios dominating the traditional wealth management space. Fidelity Investments has trillions in assets and a stranglehold on the 401k market. Fidelity mutual funds and Fidelity ETFs are staples in almost every American retirement account. Then you have the disruptors like Robinhood, which changed the game with Robinhood stock trading and Robinhood crypto. Robinhood app users are incredibly loyal, and their move into Robinhood cash management and Robinhood fractional shares kept them relevant. But SoFi is carving out a middle lane that is becoming increasingly wide. They are not just a trading app, and they are not just a legacy bank. They are building what they call the financial super app, and the Q3 data proves it is working. They added 900,000 new members in the last quarter alone, bringing the total count to 12.6 million. That is 12.6 million people who are potentially taking out loans, using SoFi Invest, buying SoFi ETFs, and banking with them. So, if the business is so good, why the stock offering? Why dilute shareholders by $1.5 billion when the stock is trading near its 52-week highs? This is where we have to put on our investigative hats. A company does not raise that kind of liquidity just to let it sit in a savings account. You raise that kind of capital because you're preparing to do something big. The market is pricing in the dilution today, which is why we're down at $27.86. But the smart currency is trying to figure out the use of proceeds. Management has stated it's for general corporate purposes, which is the standard legal boilerplate, but let's read between the lines. With interest rates stabilizing and the regulatory environment potentially shifting in 2026, SoFi might be looking at acquisitions. They might be looking to pay down higher-cost debt to boost margins even further. Or they might be preparing to aggressively expand their loan book now that the credit cycle seems to be turning. We need to talk about the SoFi trading platform and SoFi active investing, because this is where the battle for the retail consumer is being fought. Years ago, if you wanted investment help, you went to a physical branch. Now self-investing is the norm. Platforms like Interactive Brokers offer incredible depth with their Interactive Brokers trading workstation, but they can be complex. Interactive Brokers fees and Interactive Brokers stock trading mechanisms are great for pros, but they intimidate the average person. SoFi Invest hits that sweet spot of usability and power. They have integrated SoFi Robo-Advisor features directly alongside active trading, allowing the user to have a passive strategy and an active strategy in the same ecosystem. This cross-buying behavior is the secret sauce. The data shows that a huge percentage of new SoFi Invest accounts come from existing banking members. They catch you with a high-yield savings account, and suddenly you're buying NVIDIA stock or Tesla stock through their app because it's just one click away. Let's pause for a second and look at the lending side, because that was the original bread and butter. Personal loans and student loan refinancing was how SoFi started. The expectation going into late 2025 was that high interest rates would crush their loan volume. Everyone thought demand for refinancing would dry up. The reality? They originated $9.9 billion in loans in Q3, a 57% increase year over year. This is staggering. While traditional banks were tightening credit boxes and retreating, SoFi used their superior data and the Galileo technology platform to identify high-quality borrowers and keep the spigot open. They're capturing market share from legacy institutions that are too slow to adapt. It's similar to how Apple stock became a dominant force not just by selling phones, but by creating an ecosystem where leaving is painful. SoFi is doing the same with finance. The technology side of the business often gets overlooked, but it's critical. SoFi owns Galileo and Technisys. Think of these as the plumbing for the entire fintech industry. When other companies want to offer online investment accounts or digital banking, they often pay SoFi to use their infrastructure. It's a brilliant hedge. Even if a competitor wins a customer, if that competitor runs on Galileo, SoFi still gets paid. It's similar to the AWS of fintech argument. This segment saw revenue grow significantly, proving that their B2B strategy is starting to compound alongside the consumer business. It differentiates them from Robinhood Investments or SoFi Stock's competitors, who are purely consumer-facing. Fidelity Brokerage and Fidelity Wealth Management are massive, but they run on legacy mainframe systems that are decades old. SoFi is cloud-native, agile, and able to roll out products like SoFi Crypto or SoFi Fractional Shares much faster than the old guard. Speaking of crypto, the recent relaunch of their crypto capabilities is another massive catalyst. For a while, regulatory pressure forced them to step back, but with the changing tides in Washington and the new banking charters, they're back in the game. This puts them in direct competition with Robinhood Crypto. The difference is, SoFi offers this alongside a federally chartered bank account. You can move funds from your FDIC-insured checking account instantly into Bitcoin or Ethereum. That creates a level of trust that pure-play crypto exchanges struggle to match. It's the convergence of traditional finance and decentralized finance, and SoFi is sitting right at the intersection. Now, I want to hear from you guys because the shareholder base for this company is incredibly passionate. Comment below how many shares of SoFi you currently hold, and more importantly, are you buying this dip at $27 or does the dilution scare you off? I'm genuinely curious if you see this $1.5 billion raise as a red flag or a green light for future expansion. Leave a comment and let's get a discussion going in the section below. Let's shift gears to the future outlook and the risks, because we cannot ignore the bear case. The stock has had a massive run, up nearly 100% year-to-date, even with today's drop. Valuation is starting to get stretched. When you look at price to earnings or price to tangible book value, SoFi is trading at a premium compared to traditional banks like Citi or Wells Fargo. The market is pricing it like a tech company, not a bank. The risk is that if growth slows, even slightly, that multiple could compress rapidly. If the unemployment rate spikes in 2026, their personal loan portfolio could see higher defaults. They have managed credit risk incredibly well so far, with charge-off rates actually decreasing in some segments. But consumer credit is always cyclical.